Simon, can you please introduce yourself and your role in AKPsi?
Yeah, so I'm an econ major, I'm a freshman, and in AKPsi I'm the investments chair.
Can you talk about what led up to the financial crisis and what occurred during it?
A lot of what had to do with the financial crisis stems from what happened after the dot-com bubble burst in early 2000. And the dot-com bubble was due to many reasons, but the gist of it is that a lot of companies, especially dot-com companies, were very highly valued during early 2000, and eventually when their value above their intrinsic price was so large that the bubble burst, and then the Fed stepped in and the government stepped in, and they worked together to get the economy back to where it was before. And the biggest part of doing this was getting interest rates really low, as expansionary policy to ease the economy back to levels previous. So with the interest rate so low, the purpose of that was to get the economy going again, but it had a lot of other effects which very greatly affected the crisis in 07 and 08, and most of that had to do with the interest rates being so low on housing. And the government kept those mortgage interest rates so low by first they would lend money to the GSEs, the government-sponsored enterprises, and that would include Fannie Mae, Freddie Mac, Ginnie Mae. They would loan it at very small interest rates to these three institutions, and the responsibility of the GSEs was to then in turn lend that money to the mortgage originators, which would just be like local banks that would give out mortgages to potential homeowners. And the whole purpose of this was to get more people into homes. And on the government side, that initiative was there for a long time. Ever since like the 1970s, with the Community Reinvestment Act, the government tried really hard to get people to move from urban areas to suburban areas, get more people into homes. And so that whole GSE chain to the homeowner was the government's initiative in doing that. And then on the Federal Reserve side, with monetary policy, it was a low interest rate. And if you have lower interest rates, more people are going to want to take out mortgages because the rate that they pay every year for the 30-year or whatever mortgage they take out is lower. So what happened though is, because interest rates were so low and the investment there wasn't very profitable, Wall Street saw how profitable the GSEs were being from their chain, and they wanted in. The GSEs would buy the mortgages from the mortgage originators and sell it off to other parties and make a lot of money in that difference of the amount. The reason that the mortgage originators were selling off the loans to the GSEs was because of this transition from what's called originate to hold to originate to distribute. Before, originate to hold loans were when the mortgage originator would give out a loan, and they would hold that loan for the length of, until maturity. So if it's a 30-year loan, until either the 30 years or until the person repays it, the mortgage originator would hold on to it, and they would have a relationship with the client and make sure that the client wouldn't default and nothing was wrong. And then when we moved to this originate to distribute model, the relationship between the mortgage originator and the client just got completely destroyed, because now the mortgage originator would sell off the loan, so they didn't really care about default anymore, and they kind of lost that relationship they had with the client. Wall Street wanted in on buying the mortgage and then selling it off. It was like the new thing. It was essentially where the bubble was coming in. So when the GSEs would buy the mortgages and then sell them off and make that huge profit, they also would be able to guarantee against if the homeowner would default, just because they're sponsored by the government. So the government said, if the homeowner who took out the mortgage said, I'm bankrupt, I can't do anything, I can't pay it, the government would step up and put up the difference. For Wall Street firms, they couldn't do that. They're not sponsored by the government. So what they would do is they had their own little chain that connected Main Street with Wall Street. So what they would do is they would buy the mortgages from the mortgage originator, and lots of mortgages. They would leverage themselves to like 30 to 1, $30 borrowed for every dollar they had. And with these mortgages, they'd put them together and they would call this new product a mortgage-backed security. And that was essentially what the GSEs were doing, but Wall Street got even fancier. What they decided to do was they would have special divisions in their like physical offices. They would be called special purpose vehicles, SPVs, and the SPVs were actually registered under the Cayman Islands. So the Cayman Islands was a great place to do anything, of course, until people found out about it, because the Cayman Islands didn't really tax you. The Cayman Islands didn't really look into what you're doing, and most importantly, the Cayman Islands didn't care whether you put up capital reserves or not. And capital reserves are super important because that's kind of a safety net for what happens if your transaction goes wrong. If you place a bet and your bet goes wrong and you have clients, you're going to want to have some kind of safety net. But if your SPV is in the Cayman Islands and no one really cares. So what ended up happening is the special purpose vehicles, when they were registered there, they would have these benefits, and they would take those mortgage-backed securities and repackage them into what's called CDOs, collateralized debt obligations. And the CDOs had different tranches, and the tranches were based on riskiness. So the highest tranche would be, it would call it super senior, and it had the safest assets. And it wasn't really that the assets were the safest, but because all of the mortgages were put together, from that, when money started coming in from homeowners, it would be a revenue stream, and it kind of had this waterfall effect where it would start with the top tranche, the super senior, and then move down to senior, mezzanine, and equity, which is the lowest tranche. So when you look at that process, and when you look at those tranches, the highest tranche, super senior, the way different from the equity tranche on the bottom was that it had the highest chance of getting paid, but it also had the lowest return. So if you, like a lot of hedge funds bought into equity funds, equity tranches, and hedge funds are obviously really risky. So when they bought into the equity tranches, they basically, it wasn't 100% certain that they would get money. In fact, not nearly 100%. It wasn't even rated because it was the lowest of the low. So the chance of the money coming in wasn't that high, but when it did come in, the rate of return was very high. So this process was all nice and great until the demand for the mortgages was so high that the mortgage originators stopped really caring about the requirements to become a homeowner. So they no longer, really looked at your income. They didn't really care about you at all. You just got to come into the office and say, I just want a mortgage. And a lot of people did that, and a lot of people, they came in, they got mortgages for millions of dollars when they really didn't have an income or a job. And eventually, obviously, these people couldn't repay their loans. And that's really what caused the housing bubble to burst, and the supply of homes to, be lower than the demand, because all these people no longer could pay the mortgages, and it would make more sense for them to just foreclose and leave the homes. And when that happened, money started drying up in the entire chain of securitization, and the money that the homeowner paid to the mortgage originators would go to on and on and on. It would dry up, and the person at the end, whoever invested in it, the hedge fund, the pension fund, whatever, couldn't get their money. And that's really what blew up the entire thing. What blew up Main Street with the housing, and also the liquidity squeeze on Wall Street. They were so highly leveraged, they owed so much money, and they could no longer pay it back because money wasn't coming in. So that's what happened in the housing bubble and how it burst.
So why wasn't there any government regulation?
Well, what happened with regulation is that before this industry even became so popular, so Alan Greenspan was the chairman of the Federal Reserve, and Alan Greenspan was all for having as little regulation as possible. He's a big free market guy. He thought that it would be a profitable business, and if you regulate it, it wouldn't be profitable, which is of course true. And if you regulate it, it wouldn't really work out, because this is the kind of thing that you got to take the free market course and it will work out. And that's what he said. And there were a few people who came out and said, this isn't a good idea, we need more regulation. But in the end, he's the chairman, and what he says went. And obviously it didn't come out that well because of the way we are now.
All right, Simon, thanks so much for your time.
No problem.